Hey, what's going on everyone? It's Griffin here, and in today's video we'll be speaking about generational wealth in the context of recessions, which, newsflash, if you've been following financial news and hopefully my YouTube channel over the past couple of months, well, you would be well aware of the fact that we've been seeing some general economic slowdown, which could very well lead us into a longer term recession. Now you might be wondering to yourself, hey, aren't we already in a recession? After all, the S&P 500, which constitutes the 500 largest and most influential companies in America, is down roughly 15% from all-time highs, and it was even down over 20% from all-time highs only a couple of weeks back. Well, technically speaking, the stock market doesn't go fully hand in hand with the economy, in that a recession is not the same thing as a bear market when it comes to the stock market. A bear market is characterized by a period of time where stocks are down more than 20% from recent highs. On the other hand, a technical market recession is when an economy sees 2 consecutive quarters of negative GDP growth, basically sustained economic decline for 6 months or more. So here's the thing though, in Q1 of 2022, the US economy experienced a decline of 1.4% over the previous period, and we'll be getting information about Q2 on June 29th, so in a couple of weeks. And if we end up seeing another quarter of negative GDP growth, well, from a technical standpoint, we would be in recessionary territory, even though most likely not as severe as some of the past recessions, such as the 2008 recession and even 2020, when employment rates skyrocketed and consumer spending was extremely low. But as of right now, despite everyone being severely impacted by these out-of-control inflation levels, which again are the highest we've seen since the 1980s, while unemployment remains historically low at 3.6%, and job growth is also very strong considering the circumstances. A growing number of economists are really starting to fear a potential recession sometime in the next 12 months, mainly due to growing worries that rising borrowing costs for consumers and businesses, especially after years of near 0% interest rates, could strike a pullback. And that's very well a possibility that could materialize based on macroeconomic circumstances right now. Okay, but what does this mean for you in the context of wealth in a recession? Well, I'll preface this with saying that becoming wealthy is generally a multi-decade process that's a direct reflection of the actions that we take towards our finances and our money, especially during periods of economic strain when it really feels like everyone's panicking and you should be liquidating, selling everything, and running the other way. The concept of wealth, though, ultimately comes down to your personal net worth, being the difference between your total asset value and your total liability value. That is the true value that matters, not the income that you're making on a year-to-year basis. In fact, I even made a video a couple of months back speaking about the 3 main elements that differentiate the middle class from the wealthy, and the number one main element, at least in the long term, was the ability for the wealthy to actually invest and deploy capital during market recessions when asset values were at significant and deep discounts. Ultimately, recessions are when the largest transfers of wealth and financial opportunity for those who are actually ready to take action end up materializing. This was the case in basically every recession and was certainly the case in 2008 and 2020. The bottom line is that when you keep up with the economic and financial news, it seems like the world is literally coming to an end and the Armageddon is right around the corner. Here are of course some potential causes for concern, right? Multi-decade high inflation levels, increased interest rates, stocks are in a bear market, war over in Ukraine, supply chain issues. Ultimately, the list can go on and on. And don't get me wrong, these are significant events, but if you're someone who's in a position to continue maintaining your income sources, your main income sources, and hopefully you have an emergency in place, well, looking at a recession in the near future shouldn't necessarily be massive cause for concern and worry. Rather, this should be viewed as an opportunity for actually taking advantage of depressed asset price points for that long-term growth and getting in at a much lower cost basis. So let's actually break down some of these different asset classes that you could potentially invest in during a recession for that long-term growth of wealth. But first, let's speak about today's video sponsor, YouHodler, which is a beginner-friendly cryptocurrency exchange and crypto lender that allows its users to earn up to 12% interest on their crypto deposits. You can think of YouHodler as a sort of bridge between conventional centralized finance like banks and then the DeFi economy, being decentralized finance, of course, where the goal of the platform is to allow its users to maximize the yield on their crypto holdings. It's no secret, of course, that interest rates on cash holdings have been basically near all-time lows over the past couple of years, but interest rates on crypto holdings can actually be significantly higher. And this is exactly why YouHodler allows its users to earn interest on their Bitcoin, USDT, and holdings of other cryptocurrencies by simply depositing their crypto into the YouHodler savings account and earning bi-weekly interest payments. In fact, here are the interest rates offered by YouHodler, and we can see that they offer up to 12.3% on USDT USDT stablecoin, which would be unheard of with any traditional savings account or even with other types of income generating investments like dividend stocks or even fixed income instruments right now. Now, above the high interest crypto accounts, YouHodler also offers a couple of other features and products such as crypto loans, where you can use your crypto holdings as collateral for loans at up to 90% loan to value, and interest is only paid once at the end of the loan term. Of course, though, as with any loan, it's important to be cautious and fully understanding of the details of the loan in question. But essentially, YouHodler really just wants to allow its users to have full flexibility over their crypto holdings. So if you're interested in learning more about how you can earn high interest on your crypto holdings, make sure to check out YouHodler today using the top link down below in the description. Thanks a lot to YouHodler for sponsoring that portion of today's video. It's truly through opportunities like these I can continue making all of this content for you to enjoy. With that said, let's get back to the video. Starting with the largest asset class in the world being real estate, which includes homes, rental properties, commercial real estate. All of these make up and constitute an asset class that, of course, get impacted by swings in the economy and, well, recessions. Unlike some other asset classes, though, real estate values are affected by dozens of elements that all come into play, like supply and demand, interest rates, population growth, actual geographic location in question, all of which make this an asset class that can be a little bit more difficult to analyze from a global standpoint. Now, the most recent recession being 2020 didn't actually even have a negative impact on real estate price points because this was sort of an artificially induced recession that was caused by business closures and the pandemic. In fact, slashing down interest rates near zero are really the main element in question that allowed property prices to run so significantly over the past 2 years. Historically speaking, though, interest rates alone tend to not have a huge correlation with real estate prices, as we can clearly see from this chart. What we would need to see is a huge influx of inventory coming onto the market in order to crash price points, basically significantly increasing the supply with demand staying constant, right? And this could very well happen considering very high inflation and other factors that could continue sending us into a recession. So with this in mind, although recessions are pretty much always seen from a negative lens, well, I would even somewhat welcome this type of situation, seeing asset prices, specifically real estate, coming down, right? Because again, I'm not in this for the next year or two. I'm looking at creating generational wealth and massive levels of cash flow over the next several decades, right? And so really, this is how I believe real estate should be approached in the first place anyways. In a scenario like this, even if the market value of my properties went down 15, 20, 30%, well, this doesn't really matter because considering a long-term hold, those properties are still generating the same amount of income each and every month. And in fact, if you've been watching my recent videos about real estate, I always try to purchase properties where there's equity on the buy anyways, regardless of the market environment, where I can come in and actually add value to the properties, which significantly increases the market value. So even the properties right now, if they go down 15, 20%, I'm not in a position where I'm underwater on the value of the properties and the mortgage that's out on each one of those properties. This is how every successful real estate investor also approaches things. And if we do end up entering a period where we see property prices dropping 20, 30%, actually take action, purchase a property that is dropped in market value to start taking advantage of those long-term wealth building principles of real estate investing. Real estate is single-handedly the most important asset class to hold for creating a long-term generational wealth. Okay, let's now dive into an asset class that's a bit more accessible to the masses and everyday investors, being exchange traded funds and just stock market investing in general. Right, so we looked at the general market earlier on in the video, as well as the S&P 500 being off quite a bit from recent highs, as well as the fear and greed index still in fear territory for several months now. I've said it before and I'll continue saying it again, general market movements such as this one really shouldn't be of any importance to you if you are investing for the long term at a minimum of 5+ years, which you should be in the first place. The S&P 500's returned investors over 20% annually over the past 3 years, even despite the 2020 crash, which sure was absolutely not sustainable long term. But even if we zoom back to 2000, average annual returns of over 10%. Single-handedly above any other active strategy, the most important factor for success when investing in the stock market long term is continuing to actually stay invested and take advantage of opportunities such as recessions to lower your cost basis, again, for that long-term growth of wealth. Here's an example. Back in 2008-2009, when the entire financial economy worldwide was basically melting, shares of the SPY ETF, which is an S&P 500 index ETF, were trading in the mid $70 range before bottoming out and recovering for one of the largest bull runs in history. Imagine not taking advantage of this, and then also the same thing applies back in 2020. Not taking advantage of these massive drops in market value are huge detriments to long-term growth of wealth in the stock market. Many retail investors lose sight of long-term market trends when the markets are melting, but fail to realize that actively getting in and out of the markets tends to be counterproductive. And the same thing applies really here to blue chip quality dividend stocks. stocks, where companies that are actually financially strong, despite the fact that their actual price point is dropping, this doesn't necessarily change anything from their underlying financial strength and really just company strength moving forward, right? So if you're able to get a stock that is 20% below the actual price that it was trading at before, but the company is still continuing to grow their income each year and continue raising their dividend payments, well, this is a surefire way to continue building your wealth over time. This is not a get-rich-quick scheme or anything that's going to take a couple of years, but over the long term, creating generational wealth through quality blue chip dividend stocks as well as quality broad market low cost ETFs is really a great way that basically anyone can start creating wealth over time. Hey, by the way, if you want to learn more about stock market investing as a whole with ETFs, blue chip dividend stocks, as well as other types of investments, make sure to check out my full stock market investing course. It used to be $200 and I decided to throw it up for free on Skillshare. You can access the entire thing, all of the 50 video lectures entirely for free on a 30-day free trial of Skillshare. So if you're interested, I'll leave a link down below in the description. And finally, let's briefly speak about crypto, specifically Bitcoin, which realistically the relationship between Bitcoin and recessions isn't necessarily super clear, as after all, Bitcoin was created in 2009 and over the past 10 or so years has had its own set of massive peaks and valleys, expanding by thousands of percent, followed by 85% plus crashes. Right now, we're in a period where Bitcoin sold off by over 50% from all-time highs and has been trading sideways for the better part of a month and a half. And what's interesting though is that, as we can see from this chart, over the past 2 years, the quantity of Bitcoin outflowing from exchanges towards personal wallets has been massive. So this essentially means a lot more Bitcoin hoarding and basically instills confidence in the fact that investors are viewing Bitcoin as a viable store of value as well as sound money. I'll be making a really thorough video quite soon going over Bitcoin's value traits, but for now I've been continuing to see this period where markets are down 50% or so as an accumulation phase, where I've continued buying around $500 give or take a Bitcoin every single month, regardless of the price that it's currently at. And this isn't even to mention the fact that the next Bitcoin halving is expected to be in 2024, where historically speaking, there's been significant positive movements for Bitcoin leading up to and after the halving period. All of this to say that recessions need to actually be viewed as an opportunity for buying into assets at depleted price points rather than a moment to panic. Wealth is directly tied to increasing your net worth over time. So this means accumulating assets, especially during periods where asset prices are lower, and maintaining your liabilities either stable or reducing them over time. Thanks a lot for watching today's video. If you enjoyed it, make sure to drop a like. It really helps my channel out, and also consider subscribing, hitting the bell button to be notified of new and upcoming investing and personal finance content. Thanks again to YouHodler for sponsoring today's video. If you want to check them out, top link down below in the description. And with that said, I will see you in the next one.